Let us move to the Talos Market Impact Model, which is something I'm really excited to share with you. We're going to have a paper about this that have been submitted to a conference and coming out in Jan. We had a blog post about the modeling and the concepts sent out yesterday. And if you have any questions, you know where to find us. What do I mean by market impact? Let's start with the diagram on the left-hand side. This is coming from a typical equities textbook. Assuming I want to trade 2,000 shares, let's say that I have two options. Option number one is that I will trade the 2,000 shares right now, showing with the dotted gray line, which means that I will have some expectation of pushing the price away from me because I'm sweeping the book, and there's going to be some reversion happening. But if I were to take these 2,000 shares and trade 1,000 shares now and then 1,000 shares a little bit later, the expectation is that the overall price impact is going to be lower, and we're going to be showing it and proving it also mathematically. But the risk of missing the arrival price is larger. This is denoted here by the risk exposure. So again, the levers that I have to play with is to say, I trade now, I know exactly how I'm going to push the price, or I can try to time the market and trade within the next 5 minutes or 30 seconds or 5 hours in small portions in the market, but the dollar that I will trade in 4 hours is running at the risk of missing the arrival price, and how to do that trade-off and how to actually make that estimation as a function of the algorithm that you're choosing to trade. In the middle chart, you can see our own Talos data. This is 50,000 parent orders, more than 50 million child executions across 50 public exchanges across the universe of our entire flow, to show on the x-axis the participation rate in the market, y-axis is the actual arrival slippage. When the participation rate is really low, you can see it's extremely noisy, and as you can imagine, it's going to be very difficult to estimate an average here, and that is kind of the expectation of arrival when you're trading higher participation, meaning you're trading a larger quantity versus the volume in the market, you're expecting to have higher impact. Once you're trading in limit order books, whether it's coffee beans, equities, or crypto, it kind of have the same shape or pattern. On the right-hand side, this is a paper by Bank of America showing their equivalent for equities. If you notice carefully, they omitted anything under like 1% of participation rate. And if you're looking very carefully on any market impact academic paper, you will see that they do the same. Because at the smaller participation rate ranges, it's extremely difficult and noisy to do an estimation. We could not afford doing the same. We have a variation of different clients in different ways. Some of them trading 5 BTC in 48 hours, some trading 150 BTC in 3 seconds. I wanted to be able to cater for all the different use cases with an appropriate model. So why do we need the market impact? I'll just summarize it very quickly. Should I sweep or should I use VWAP or TWAP to trade passively, right? If I sweep right now, I know what's the price, but if I were to trade VWAP over 5 hours, what would be the expected slippage from arrival? I want to be able to know that. Shall I trade in the morning? Shall I trade before and after US market open? As you remember, volatility, spread, and volume has different statistical patterns throughout the day that will have implication on your expected impact. I want to be able to measure that. Which algo should I use? A participate algo, a TWAP, a VWAP? Should I trade for 5 minutes? Should I trade over 3 days? What will be the implication of the expected cost associated from arrival? And so on and so forth, and multiple different ways that we can think about. And our usual answer used to be really hard to validate. Up until we put the effort and the work, and we have this unique data set of actual parent orders where we can see the entire life cycle of an order from arrival price all the way to completion, to be able to come up with the appropriate regressions, to come up with some appropriate model to be able to estimate that. So far, make sense? Cool. Does size matter? These are one of the most prestige market impact professors in the space, developed their models in the equities world. On the left-hand side, you have Professor Ramakant. On the right-hand side, you have Professor Bouchon. Professor Ramakant on the left-hand side saying that market impact is a function of volatility and duration. If you're looking at the formula at the bottom, there is no concept of the quantity that you trade, meaning that Ramakant say that if you were to trade over 1 hour $10 million of BTC, or whether you're going to trade $100 of BTC, you're expecting to have the same impact. It kind of makes sense in his case because the data sets that he's been looking at are such that the quantity being traded is always proportional to the horizon. So in a much more mature equities market and institutional flow there, people doing a very good job at trying to proportionally say if I trade larger volume, I'll trade larger horizon. So as you're doing the regression, the quantity seems to be negligible. On the right-hand side, Professor Bouchard is taking into account both volatility and participation rate. Of course, participation rate is nothing but the quantity you're going to trade divided by expectation of volume. And you can see on the right-hand side here, there is a square root type shape. That's square root of how volatility and the participation rate joined together has been proved in so many different academic papers and for limit order books make intuitive sense. The other thing that in both of these formulations there is not much of a presence in is a decomposition between what I like to call physical impact to the risk of missing the arrival price. So I don't want to just make an estimation of the physical impact that being traded. I also want to be able to estimate the risk of missing the arrival price as two separate components. And why that's important and why that will allow you to incorporate your own alpha view is something that I'm going to show in a moment, but bear with me. The data set itself that we've been using is, again, June to July 24 to 25, not including the 11th of October. Across the top 60 spots and perpetuals, anything between BTC, ETH, Doge, Sol, and all the rest of the good ones, specifically versus USD, USDT, and USDC, across all our different strategies, across 50,000 parent orders, and so on and so forth. Big, statistically significant data set, extremely diverse because we have asset managers working with us, we have mid-frequency systematic traders, we have activities of all sorts of different horizons and different alpha profiles that make it diverse enough or capture enough of the variance of what happened in the market to make it statistically significant. Without boring you with the details and the maths, this is the model. And let me try to explain to you what the model actually represents. It is comprised into three components. The first component will be very intuitive, what we call the spread cost. Expectation of how much you're going to be paying as a function of the bid-ask spread, denoted as C1 times the expectation of the spreads in basis points. Remember, from execution alphas, I have now the predictions of spread, volume, and volatility in intraday. I can be creative. This is manifested into the regression model itself. The temporary impact is a function and combination of the expectation of the volume in the market as well as the participation rate. But if you notice, it doesn't have a square root term. Instead of that, we plugged in a sigmoid function that attenuates itself as a function of the participation rate. In plain English, what it means is that under certain participation rate, our model would look like square root. And under other participation rate, we calibrated the power so that we can fit into the data in the best degree possible. So we don't restrict ourselves only to a square root model in that case, and that yield just a higher R square and a higher conviction power. I'm going to show you exactly the implication of that in a moment. The last component is the risk impact, as I mentioned. So this is a measure of every dollar that you're trading later is running at the risk of missing the arrival price as a function of the expected volatility over the horizon of your trade, as well as the time horizon that you're going to be trading. There's also a sigmoid calibration there, but I just made the formula a little bit easier for consumption for the presentation. As I mentioned, there is a full 40-page academic paper on this, will be published beginning of next year, and I'll be happy to share with more information. Model validation. So there's no point of me showing you a fancy model without showing you how it actually performed. So on the diagram that you see on the left-hand side, the bars representing different decompositions of actual arrival slippage. So every order that has been experiencing an arrival impact of 0 to 5 basis points will follow into that bucket. and continue going downwards. And you can see on the right-hand side the percentage of distribution. Good news, 26% of all the orders within our system are appreciating somewhere between the 0 to 5 basis points. That's just a nice indication our algo is doing something sensible, which is great. The light green representing the actual arrival slippage measured. Again, arrival price versus the average execution price. Take the difference between them, multiply by 10,000, you get the basis points, right? And the Talos model prediction is in dark green. As you can see, the diff in basis points on the side, it is kind of becoming wider and wider as a function of the actual slippage from arrival become bigger, but for all intents and purposes, for the measurement of trading under this particular configuration or trading via another configuration, this is good enough. There are so many different applications for this. There's going to be an implementation shortfall from arrival algo based on that formula, doing a multi-period optimization, something maybe for another session. Hopefully that makes sense. Yes. One thing is really, really important for me to mention in relation to market impact models in general. Please do not come to me and say, Eliad, you said that it's going to cost 20 basis points, and I end up paying 23. Your model doesn't work. These models are really, really good at making a delineation between one type of configuration of execution versus another. Whether it's 20 or 23 or 18 is very, very difficult to tell, and there is a lot of noise around that. But whether a particular algorithm of trading is twice as expensive versus another, I can say that with good confidence. And this is exactly what the pre-trade type capability is providing. So hopefully that's clear. Just to talk 1 second about the sigmoid function. When you're using the square root law, this is what happened as a result. As you go into the really small participation rates, you're underestimating by about 4 basis points. But by calibrating that sigmoid function and changing the model from a square root to something a little bit different as a function of the participation rate, I at least get a better understanding of the average slippage within those very, very difficult buckets to estimate, and this is why it was important. In R square terms, that increasing the model R square by at least twice as much, so pretty important. We're kind of coming up with time, even though I have so much more material to explore. I will try to continue another 10 minutes. Please. In fact, for perps, it works fantastic because the perps are really liquid in nature. So all the nitty-gritty dynamics of a limit order books working pretty consistent and statistically significant in the perpetuals world. On the tail end of asset that has very thin liquidity, yeah, definitely there's going to be more noise. In fact, my volume and my spread and my volatility predictions for those assets are going to be also noisy in nature, but probably better than having nothing. As in, even with an R square of something like 10%, you're getting a better understanding of what's happening versus what currently being done, which is a little bit of a finger in the air. We're speaking with some of the biggest leverage providers in the market, and they want to have a calibration of that model to say what will be the expectation of impact after a shock, as you mentioned. So the way to do it, practically speaking, is to filter out the data as a function of, say, BTC return, and looking only on regimes by which the return was 2 or 3 standard deviation away from the mean, and then do the calibration only on that prism, if that makes sense. Yes. All right. I want to show you this diagram. I want to show you a demo. I have so much material which I'm not going to go through, but we'll keep it short and sweet. So let me give you a fun usage example on the left-hand side. Say I wanted to trade BTC, and I want to decide whether I'm going to trade it over 1 hour, or whether I'm going to trade it over 2 hours, or whether I'm going to trade it over 5 days. I came up with the expectation of impact using my Talos Market Impact Model, and decompose it into the spread, the temporary, and the risk impact, called permanent here, but it should be called risk. So what happens here? If I were to trade over 1 hour, I predominantly influence the price by the temporary impact as a function of my participation rate and the volatility. Again, my participation rate will be really high because my horizon is smaller. As the horizon becomes bigger, you can see that light green is reducing in some sort of a square root-like shape, which makes sense because I'm now trading over a larger horizon with the same amount of quantity. My participation rate reduces. That component will decline. The spread cost is almost negligible here because BTC at the top of the book is very, very thin, so the implication of the spread cost is almost negligible. I think it's also a good indication that our algos are doing a good job, because on average, I think we see somewhere around the 80 to 90% maker fills. Everything is being designed to be passive first, and that get manifested in the way that the regressions actually work. And then the risk of missing the arrival price is, of course, growing as a function of the time horizon that you're trading. So if you're trading over 5 days, your participation rate is negligible. All you get is dark green, which is the risk of missing the arrival price. So in a situation like this, let's assume that you're buying, but you think that the market is coming your way. In that case, whatever I calculated as the risk of missing the arrival price might not be relevant for your use case. So you can discount that or decide to even ignore that and just focus on the physical impact. If I were to take all the components into account, then maybe trading somewhere along the lines of 3 to 4 hours seem to be a good balance, where the temporary is reducing and the risk impact is not increasing too dramatically. So this is a perfect example of how you can calibrate your horizon using this type of impact models. I would also leave you with the right-hand side graph, which is the ultimate obvious next step of that. That formula at the bottom is the Arkman-Chris cost-risk minimization framework. And that nice diagram that you see is like the Markowitz portfolio optimization, but for execution, where x-axis is the risk of missing the arrival price, y is the expectation of the physical interactions with the order book, and then every single dot on this efficient frontier, I label them as low, medium, and high, as an example, is a solution for a different execution path. Theoretically speaking, the low urgency is equivalent to a VWAP algo, which optimized to have the lowest expected participation rate because it's trading in proportion to the overall volume in the market, but it tried to do no minimization on the risk of missing the arrival price. So you get the highest risk, lowest cost. The high urgency is an equivalent of a participate algo, or what people like to call POV. I decide I'm going to be 10% of the overall volume. Every time I see volume coming through the market, I'm going to go and punch the market and get that liquidity. I'll get it in a much shorter horizon versus VWAP, so I'm going to have a strong temporary impact. I'm going to reduce my overall risk. And any solution in between are more optimized solutions that one can choose, depends on your alpha appetite and depends on the urgency or the risk aversion you want to take versus the risk of missing the arrival price. So this is like a typical IS algo implementation, something that we're going to work on in 2026. I have one more fun demo to show you, and I think we're going to close this off. This is a nice demo that we have prepared. We are actively building what you're going to see now on the screen into our platform. I believe early Q1 2026, this will be available for people to consume. So let's assume that I want to trade the BTC using VWAP. I think it's set up to 30 minutes. And rather than placing the order and go and buy, I want to get a sense of the risk and cost implication of trading that. In the future, you'll be able to click on the pre-trade button, and it will give you some indications where you can see at the top, the overall impact is going to be 37 basis points, decomposed into 14 basis points or so of physical impact, and the remainder is the risk of missing the arrival price. full details of the actual cost implications, some other trade predictions based on the data sets and the predictions that we have, execution alphas at the back end, the expectation of the schedule, the composition of the spread volume and volatility expectation as a function of the market that you're going to trade, going to be available. And then I'm going to ask myself, okay, what will be the equivalent if I were to trade TWAP instead? So I can try a TWAP algorithm, and let's click on that. And now we have an ability to do a little bit of a comparative analysis between the two. One of them have higher risk, the other of them have a lower cost, and I can make more informed decisions. I can take a look on the full details of that as well. So you can imagine I can create another 5 or 6 different scenarios, click on the scenario of my choosing, and go and trade. All of these scenarios will be persisted at the back end as well, and you will call me in a month's time and say, Eliad, now do some TCA for me and show me what was the implication of the overall slippage experience as a function of the pre-trade and the function of how I traded, what will be the right way to optimize things, and we're going to have that cycle of working together to refine and fight slippage again and again and again. So this is exactly the pre-trade tool I was mentioning before, which helping with those comparisons. You can imagine I could also just focus on, say, VWAP or quantizer or any other algos of my choosing, attenuating multiple parameters, see the expectation of impact implication on that, changing my venue selection, because every time I adding a venue, I changing my liquidity profile, I changing my expectation of volatility. That will have implication on the way that the expected impact going to look like. And I think we're going to close it off here. So in conclusion, and just to kind of looking towards 2026, a couple of interesting things coming up. We're going to have very, very strong focus about micro expectation of alphas as a function of order book imbalance, order flow imbalance, doing tactical passive placements in even better ways than we're doing before. Implications of that market impact model would allow us to create an implementation shortfall from arrival algo, which is a multi-period optimization approach of risk and cost in some interesting manners. If the market mature enough and we actually want to trade some basket, some of you already trading basket, creating a basket algo using a cost-risk trade-off is going to be very relevant as well. And looking forward to continue having nice conversations with you, see what will be relevant, and we will take it from there. So with that in mind, I will stop, and thank you very much.